right, welcome back to Iron Financial. You know our mission here. We're all about forging stronger portfolios. And we do that by taking the market's biggest stories, the ones everyone's talking about, and putting them under a stress test. We cut right through the noise to get to the hard numbers. And today, oh boy, today we've got a great one. We are putting Loews Corporation under the microscope. They just dropped an earnings report that, I gotta say, on the surface, it looks like pure, polished steel. But you know us. We're here to find out if it's got a solid core or if it's just a hollow shell. Let's get to it.
Oh, yeah, exactly. And the headlines are they're screaming about this massive profit surge. The stock popped to a new 52-week high. You can feel it, right? The hype machine is in full gear. But look, I've been doing this a long time, and you have too. When the numbers look this good, I mean, almost too good, you gotta ask the hard questions. Is this really a story of genuine, powerful growth? Or are we just looking at some clever financial engineering? You know, the kind of stuff designed to fool the average investor. So that's the big question for today, isn't it? Is this thing a steel-plated fortress built to last? Or is it a house of cards just waiting for a breeze to knock it over? That's what we're here to find out.
Right. And to answer that, you absolutely need a blueprint. So here's our plan of attack. We're going to be really methodical about this. First, we're going to tackle that headline pop, you know, the shiny numbers that got everybody so excited. Then the real work begins. We're going to start peeling back the layers, looking for any cracks in the foundation. After that, we're going inside the engine room, a full segment-by-segment inspection. Then we'll hit what might be their biggest strength, that fortress balance sheet. We'll check out on what Wall Street is saying, and then, at the end of it all, we'll weigh all the evidence and deliver the Iron Financial verdict. Simple as that. Okay, let's dive right in. Section 1, the headline pop. You know, you have to start here because these are the numbers that flash across the screen, hit the cape, and cause that first knee-jerk reaction, that flurry of buying. These are the figures specifically designed to grab your attention. And you know what? You have to admit, at first glance, they're pretty darn impressive. They tell this story of just explosive, undeniable growth that would make pretty much any investor out there sit up and pay attention. So the first number that just leaps off the page is the bottom line. Net income, $402 million, just for the fourth quarter. Now, a number like that is big, sure, but what makes it absolutely explosive is the comparison. This isn't just some small earnings beat. This is a massive, massive leap from the $187 million they posted in the exact same quarter last year. Let's be clear, we are talking about more than doubling their profit. In any market, in any environment, a jump like that is a signal flare. It's something you just can't ignore. And of course, that profit translates directly to earnings per share, right? The number that really, truly moves the needle for shareholders. They reported $1.94 per share. Now, to put that into perspective for you, back in Q4 of 2024, they earned just 86 cents. So again, more than double. So let's just recap the headline here. You have a massive net income beat. You have an explosive EPS growth story. On paper, this looks like a company that just found a whole new gear and is absolutely 100% firing on all cylinders. And of course, the market just ate it up. Well, at least initially, right? The stock surged, hit a new 52-week high, almost $115 a share. And this is that perfect moment, isn't it? A huge earnings beat, a soaring stock price. I mean, it is the textbook definition of a breakout. But this is where we at Iron Financial really earn our keep. It is so easy to get swept up in that euphoria. It's much, much harder and way more important to stop and ask, is this real? Is this sustainable strength? Or is this just some polished chrome hiding a much weaker structure underneath? Because all I see is a headline that looks way too good to be true. And that, my friend, always makes me suspicious.
And you know what? Your suspicion is absolutely well-founded. Any analyst worth their salt knows that the headline number, that's just the cover of the book. If you want to understand the real story, you have to dig into the footnotes. So you are 100% right to be cautious. So let's move on. Let's go to our next section and do exactly that. It is time to peel back these numbers and really check the integrity of this foundation. We're about to apply some serious pressure and see if any cracks start to show.
And boom. Here it is. This is the first and, I would argue, the most significant crack in this entire narrative. When you put the 2 years side by side here on the screen, you see the numbers we just talked about, right? The big jump. But now, look closely at the fine print for 2024. In that quarter, their big insurance subsidiary CNA Financial took a massive one-time pension settlement charge. We're talking $265 million after tax. This was a completely non-operational, non-recurring event that just artificially crushed their 2024 earnings. So here's the takeaway, the crucial point. The spectacular growth we see in 2025, it isn't because 2025 was so phenomenally good. It's largely because the 2024 number they're comparing it to was artificially terrible. And listen, this isn't just us making this up. This isn't our interpretation. It is right there, black and white, in their own financial reports. This quote really says it all. The company itself is literally telling you that the main reason for this significant improvement is the absence of that huge charge from the year before. So that whole story, that narrative about explosive growth, it's already starting to crumble. That polished chrome we talked about, it's flaking off, and we're starting to see that the metal underneath isn't nearly as shiny as we thought. This is a classic textbook case of what we call base effects, creating an illusion of strength. Exactly. It's a mirage. The headline growth story is a complete mirage. So, okay, if the overall growth isn't real, then we have to go deeper. It's time to open up the hood and inspect the individual parts of the engine. We need to see if they're actually performing well on their own. See, a diversified company like Loews, a holding company, can sometimes hide weakness in one business with strength in another. So let's get into our segment-by-segment inspection and find out what is really driving this company, or what isn't. All right, first things first, you have to understand the structure of this company. Loews isn't one simple business. It's a holding company. It's a collection of different businesses. And as you can see really clearly from this revenue breakdown, it is just overwhelmingly dominated by one single segment. CNA Financial. That's their massive commercial insurance business. I mean, look at it. It's bringing in nearly $4 billion in revenue. Then, way down the list, you have Boardwalk Pipelines in the energy sector and Loews Hotels in hospitality. But make no mistake, the performance of CNA is the 800-pound gorilla in the room. Its health basically determines the health of the entire company. Okay, so let's drill right into CNA. Remember that $265 million pension charge we talked about? To get a real, true apples-to-apples comparison, you have to strip that out. Now, the company helps us here. They give us a non-GAAP number called core income that does exactly that. So what does it show? Well, core income actually fell. It went from $342 million in Q4 of 24 down to $317 million this quarter. And it gets worse. Their underlying combined ratio, which is a super important measure of underwriting profitability for an insurance company, and lower is always better, it actually got worse. It ticked up from 91.4% to 92.3%. So for your non-insurance folks, that just means for every dollar they're taking in from premiums, more of it is going out the door to pay for claims and expenses. So let's just be blunt. The single most important part of their business, their main engine, is not only not growing, it's actually showing real signs of weakening profitability. And believe me, the story doesn't get any better when you look at their second largest segment, Boardwalk Pipelines. I mean, look at this. Net income there just dropped from $145 million down to $110 million. Now, okay, part of that was because of a one-time tax benefit in 2024 that didn't repeat. So that's yet another accounting illusion we have to see past. But even if you ignore that, the reports talk about rising legal expenses hitting the bottom line. So let's keep score. We're now 2 for 2 on the major business segments showing real operational weakness under the surface. We're not finding strength here. We're finding another big part of the business that's actually moving in the wrong direction. All right, now the hotel segment. This one is a more complicated picture. And honestly, this brilliantly illustrates why you can never just look at one number and call it a day. If you look at the standard GAAP net income, it looks awful. I mean, profit just plummeted from $27 million to only $6 million. But you have to ask why. And the reason is a $20 million asset impairment charge. It's a non-cash, paper loss tied to a hotel replacement. But if you look at a better metric for operations, like adjusted EBITDA, which strips out weird stuff like that, you see the real story. EBITDA was up an impressive 35%, hitting $113 million. This was driven by new properties, higher rates. So, here, finally, we have a part of the engine that is genuinely running strong. The only problem? It's the smallest engine in the whole vehicle. Okay, let's just take a breath and recap where we are. The headline growth? It's an illusion. The core insurance business, the big one, is actually a little weaker. The pipeline business is down. The hotel business is strong, but it's tiny. So look, if this story was only about operational growth, you'd probably just walk away right now and find something else to look at. But that is not the whole story. Not even close. Let's pivot now to the real bull case for Loews, because we absolutely need to talk about where this company's true, unquestionable strength lies. And that is its rock-solid financial foundation. This is the steel frame of the entire structure. I mean, just look at this number, $3.9 billion. That's cash and investments held at the parent company level. This is critical. This isn't cash that's trapped down in some subsidiary that they can't touch. This is the corporate war chest. To put that into perspective for you, their total debt at that same parent level is only $1.8 billion. So they have more than twice as much cash as they have debt. In a market like this, a volatile market, that kind of liquidity isn't just nice to have, it's armor. It gives them immense financial flexibility. They can weather any storm, they can invest opportunistically when others are scared, and maybe most importantly, they can return massive amounts of capital to shareholders without even breaking a sweat. This right here, this is the kind of financial strength you can actually build a portfolio on.
And here's the thing, they aren't just sitting on that mountain of cash like a dragon, they are actively deploying it. In 2025 alone, they spent a whopping $782 million buying back their own stock. Now, you have to ask yourself, what does that tell you? It is the ultimate sign of confidence from management. The people running the company are looking at their own business, they're looking at the stock price, and they are concluding that the single best investment they can possibly make with that cash is in themselves. It means they believe the market is undervaluing their assets, and they're using all that financial firepower to take advantage of it. That is a clear, powerful signal you can't ignore.
And this slide right here shows you the direct result of that spending. That aggressive buyback program is just systematically, relentlessly reducing the number of shares outstanding. In just 1 year, you can see they've taken the share count from almost 215 million down to 206 million. And think about what that means. Every single share that's repurchased gets retired, it just vanishes, which means every single remaining shareholder now owns a slightly larger piece of the entire company. It is a slow, methodical process of basically manufacturing value for the long-term owners. This is the real heavy lifting that compounds wealth over time, even if the day-to-day operational growth is kind of flat.
And really, this all culminates in what might be the single most important metric for a value-oriented company like Lowe's, and that's book value per share. This is the tangible net asset value of the company. You can think of it as what would be left over if they sold everything and paid off all their debts on a per-share basis. And look at it. It is just marching steadily higher. It grew from under $80 a share to over $90 a share in 1 year. Even if you exclude certain accounting adjustments, it grew from $88 to almost $96. This isn't some illusory profit number we saw on the first slide. This is the real, undeniable increase in the intrinsic value of the business. So while the rest of the market is out there chasing flashy, often fake growth stories, Lowe's is just quietly and consistently building this foundation of solid value for its shareholders.
Okay, I see the argument. I get it. The operational growth story is frankly weak, but the financial foundation is an absolute fortress, and they are using that strength to build real tangible book value. It is a compelling case for a patient investor. But that brings us right to the final conflict, doesn't it? If the foundation is so strong, why isn't the market more excited? The stock gained, a measly 0.1% the day after this supposedly spectacular earnings report? It really seems like Wall Street is just as divided on this as we are. Let's dig into what they're saying. It really is a classic bull versus bear setup. I mean, look at the bull case. The professional analysts who cover this stock have an average rating of strong buy. You've got independent firms like NYSE Ratings giving it a solid buy grade. And maybe most telling, the big money, the institutional investors, they own over 58% of the company. It really seems like the so-called smart money believes in this long-term value story. But hold on, the bear case is just as compelling, maybe more so, because it's based on actions, not just opinions. First of all, that market reaction we talked about. A gain of 0.1% after that headline beat, that tells me the market saw right through the accounting noise, just like we did. And then you have this, the insider selling. This, to me, is a massive red flag. Over the last 90 days, insiders have dumped over $13 million worth of stock. You've got a director, Andrew Tisch, selling 50,000 shares. You have to ask yourself, why are the people who know the company best, the insiders, cashing out if they're so confident in its future? Actions always speak louder than ratings. And that is the absolute critical question, isn't it? You have these two completely competing narratives. On one hand, you have strong fundamentals. On the other, you have questionable growth and some pretty suspicious insider activity. So it's time. Let's put it all together on the scales, let's weigh all the evidence, and let's forge our final conclusion. It's time for the iron financial verdict. Okay, so on one side of the scale, you have the steel beams, the real structural supports of this company. That fortress balance sheet with nearly $4 billion in cash, that's undeniable. The aggressive and frankly intelligent use of that cash for share buybacks is a huge positive. And this all leads to that consistent, tangible book value growth, which is really the bedrock of this whole investment thesis. Plus, you have the professional analyst on your side. But on the other side of the scale, you have some pretty serious cracks in the facade. That headline growth that got everyone so hyped up, it's an illusion, pure and simple. When you actually look under the hood, you find the core insurance business is weakening and the pipeline segment is struggling. And I'm sorry, you just cannot ignore that level of insider selling. It completely undermines the whole our stock is undervalued argument that the buybacks are supposed to be making.
So here it is, our final verdict. Loews Corporation is not a high-growth machine. Let's be crystal clear about that. Anyone who jumped in and bought this stock based on that flashy headline EPS number, well, they fell into a trap. The growth is simply not what it seems. However, this is also not a house of cards about to collapse. It is a financially sound fortress, one that's built for durability, not for speed. The real story here is the methodical, some might even say boring, creation of value through buybacks and growing that book value. So what does that mean? It means this is a potential opportunity for the truly patient value investor, someone who understands exactly what they are buying and is willing to wait. But it is absolutely a trap for anyone out there chasing momentum or a quick growth story. Which leaves us with one final lingering question. With a business that is growing its intrinsic value so steadily, but its actual operations are moving so slowly, will the market ever wake up and properly reward that kind of durability? Or will a stock like this always trade at a discount simply because it lacks the excitement and the sizzle that the market craves? Ultimately, that's what you, the investor, have to decide.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.